to this very special edition of Crystal Ball. We are calling it the fear factor because it seems to be fear all around in the market. Suddenly, mayhem has broken out in global markets. The smugness with which a lot of Indian investors might have been looking at their own macro has been shaken, and markets have quickly come back to 52-week lows or nearly that. To discuss the state of affairs in the market with me today, Shankar Sharma of First Global. Shankar, a pleasure to speak to you again. How have you been reading the turn of events? Because suddenly there seems to be complete mayhem in global markets. Did you see it coming?
Well, even at the risk of sounding immodest, for our clients, particularly the global funds, we got very light on equities right from November onwards. And my view has been that if you're talking the globe, the U.S. market was heading nowhere but down, and that had been grinding from January last year. So if you just simply saw the market action, it was just unable to continue the way it had continued from 2009 March bottom. So it had kind of lost complete momentum. There was no steam left in the market. It was just kind of treading water. So I mean, everything was pointing towards a pretty bad 2015. Now 2015 turned out to be an average year, tepid, flattish year for most markets. India was down 6-7%. Most markets were down, around that or flattish. But that didn't mean that 2015, what one was seeing in 2015 was over, and that 2016 would be a markedly different year. My view was that I really thought that this crack would happen sometime in 2015 itself. It did, particularly China. But for the global markets to crack, it obviously took a little bit longer, because remember, this has been a bull market, or sort of a bull market. I don't believe it's been a bull market globally anyway. But most people tend to believe that from 2009 we've had a bull market, but that's still overall a trading range for global markets, not a secular bull market. But be that as it may, it took a while for global markets to roll over. And now January has, eerily started resembling, January 2016 eerily started resembling the January of 2008. If you recall, again, the first, I think, fortnight of 2008 was really, really ugly, and this is, kind of shaping up that way.
Wow, that's scary, Shankar. Are you saying that you're seeing shades of 2008 in how this year has begun? I mean, that was a 50% drop in the market. You're not suggesting it could get that ugly this year, are you?
No, I'm not saying it's going to be exactly in terms of market percentage move like 2008. I'm not even for a moment suggesting that. But of course, one market has seen something like that, and which is China. So it's not that no market has done that. But I'm not making a case for a 50% fall in market. All I'm saying is percentage moves are all debatable, but directionally and the speed of that move will be very, very similar to to what we saw in 2008, because the data out there, the Fed hiking rates, trying to convince itself more than anybody else that things are fine with the U.S. economy. While nobody seems to be convinced that is indeed the case. China is in my view, China can still fall a lot more than what it has already done, because remember, it has just kind of come back to where it was about 18 months back. It's not really fallen on a 2-year basis. If you look around Asia, you look around Australia, you look around emerging markets, Brazil, I mean, where do you make a case for even a moderate bull market or even a flat market? I mean, there is just completely no sign of hope for large parts of the equity world. So I'm of the opinion that this year, particularly in the first half, is going to resemble, in some senses, the second half of 2008.
Almost a bear market like a situation?
Well, Udayan, I mean, that's the kind of debate that I've had with many people for a while now, that actually, I mean, we have been in a bear market globally for a long time. I mean, I recall in 1999 or 2000, Warren Buffett had said that he doesn't believe that equity returns incrementally, that was, I think he was talking in 99 end or early 2000, incrementally the returns would be matching the returns of the previous 15, 20 years. And guess what? I mean, he's turned out to be absolutely right, that, the S&P 500 was 1500 or 1600 at its peak in 1999. And today it's 1900. So, over a period of 16 years, all you've got is like, a couple of % a year kind of, move. If you include dividends, maybe that's another 1.5%. So, I mean, that, in my mind, that's still a bear market. Over 16 years, if you've delivered virtually no returns, that's a bear market, right? For a foreign investor, India still remains and has remained for the last 7, 8, 9 years, in a bear market. So, I mean, what we are seeing now is, a more, stronger manifestation of a bear market. But it's already been there. It's been there on a stealth basis. We've had a bear market globally in equities for quite a while now.
Do you subscribe to the theory that the way China is moving and the way some of the data in other parts of the world are coming out, we could be headed towards a global recession triggered off by China?
First, look at the equity markets. I mean, despite these kind of low interest rates, markets have delivered virtually no returns for years on end. Despite such low interest rates, the world has delivered almost no real meaningful, economic growth. So, the fact of the matter is that if you adjust for interest rates, or if you adjust for normal interest rates and then look at equity markets and then you look at, actual macroeconomic growth, again, there has been a recession again for years, globally. So remember, this zero interest rate policy has kind of papered over or masked what is in reality has been a bear market in equity markets and a recessionary condition almost across most major economies in the world. So again, things reach a point when it becomes very apparent to the world that there's a bear market or there's a recession. But if you're a close observer of data, you're a close observer of rates, you would have definitely seen this coming. I mean, I don't think it's it's any great prescience on my part to say that I saw this. But if you're looking at data properly and you're looking at market action properly, I mean, whatever is happening is not a surprise.
What do you see falling more than, Shankar, from here? Do you see this continuing to be an emerging market problem, or do you see 2016 being a year where developed markets and emerging markets fall in tandem?
Well, if you go back to 2008 for any kind of reference, I think both of them did almost equally badly. I mean, in fact, in the first half, EMs did a relatively better because oil had rallied to $150, and generally commodities were relatively strong. So markets like Brazil, etc., were still quite resilient in the first half. Really, the crack happened in the second half. But the U.S. market was an absolute disaster. So my view is that we can say that developed markets will underperform emerging markets, and which I do believe can happen, because that's the area where the outperformance has been quite remarkable over the last few years. They've beaten emerging markets handily. So when things turn bad, then obviously people want to take money off the table on their winners rather than on the losers, because the losers have already tanked. And just to give you another piece of data, the emerging market ETF, the most liquid ETF for emerging market, which is EEM, is now $31, and it was $31 in 2006. 10 years, zero returns. So that's something that people now, probably it's like conventional wisdom that, look, this asset class is not looking good, so let's take money off the asset class which has looked good, which is primarily developed, and within that the US. So it is very likely that the US might actually get hit more than emerging markets, at least for a few months of this year. But directionally, both of them are definitely down. I mean, that is unfortunately the reality.
It's an interesting point, Shankar, because locally everybody's been scratching their heads about this FII outflow problem that we've seen in the second half of this year, and it's been a bigger problem across other emerging markets. And the general view seems to have been that it's because sovereign funds are selling because of the oil problem. You're saying that you can't just wish it away as just an oil-related problem. There is general disenchantment with the emerging market equity class.
Exactly right. Again, looking at data, looking at history helps. Emerging markets had been an absolute dog equity asset class till 2003. Throughout the 90s, for instance, India, our dear old India, didn't take out its highs of 1992 till the late 1999, tech boom, and that too, it was very centered around the technology end of the market, which drove the Sensex to 6,000 odd, right? But the old economy companies remained flat for nearly 10 years. Larsen and Toubro actually, again, I put that as a slide to presentations to investors. That guess what the returns Larsen and Toubro delivered over 10 years was in the 90s. That's precisely zero for 10 years. So the fact of the matter is, emerging markets had been a terrible asset class through 80s, through 90s, and for a brief while in the tech boom, markets like Taiwan and India did briefly well. But that was, very, very short-lived, as you all know. That fizzled out within a matter of a year or so. The real bull market in EM started in 2003, and by 2007 it was all over. And after the 2008 crisis, the emerging markets have gone nowhere but down. Again, China becoming, sort of coming out of the blue, delivering a cameo innings of, 150%. But then we know how that is ending. I mean, that's not a bet any sensible fund manager can take, the way the China markets have behaved. So rationally, emerging markets have done nothing for investors for decades on end, barring a brief period of 4 years. And now people are going back and saying that, guess what, guys? I mean, just if you look at the ETF data, 10 years, zero returns. Why are we even looking at this, set of, equity markets? Why can't we simply, focus on what is well understood? Because remember, again, most of the money is anyway coming from the West, and within that the US, where tech has been doing reasonably well. There are enough pockets of growth within the US economy, even in consumers or in technology. So why do we even need to go and waste time looking at these kind of markets which have promised a lot but delivered very little? So it is not about sovereign wealth funds alone. There's a general problem when you look at emerging market long-term returns shorn of these 4 years between 2003 and 2007.
Where does that leave India? We'll talk about that with Shankar in a minute, but we need to take a quick break before that. We're back in just a couple of minutes. Don't go away. Crystal Ball returns after the break. Than a spot of bother, but India is much better, and it should stand out as almost a separate asset class. Do you buy that story?
First of all, India is not an asset class. I mean, it's another equity market. I mean, this is just too much of self-glorification when we Indians start saying that. And I used to hear the story back in 2006 and 7 when again the same case was, a similar case was made, that India belongs to a different planet because it's a different asset class. Yes, it's a good market, and I've believed that for decades now, that given the structure of our markets, given the quality of our companies in general, given that we have commodity companies, but we also have branded companies, we have consumer companies, auto companies, FMCG companies, IT companies, pharma companies. So this composition is unavailable in any other emerging market. This is more like a developed market structure. So within that context, in times of crisis, India does end up behaving in most periods. I mean, 2008, of course, we fell, I think, 60–65%. But forget that for a minute. I mean, if you look at most crises, India does almost similarly to what a developed market might do, because of the inherent structure of India, or the Indian equity markets being very, very good. But my view, again, for the last 18 months or so, I have said this openly, is that there has been a stealth bear market in large caps. That's not where you're going to make any money at all. But on the other hand, there has been a big stealth, or in fact not even stealth now, it's been a big bull market in mid caps and small caps. And that's the area that I have been most interested in, because I have seen nothing that excites me about GDP numbers in India. And therefore, if you're not looking at big top line growth for the economy, which is a GDP number, then it is it stands to reason that that won't then translate down into big top line numbers for the large companies in the economy. And more so now, when you're, while the real GDP growth, if you believe, and nobody seems to believe the government numbers, and that's rational not to believe these numbers, but the 7.5% is like 5% if you look at the nominal number, which is like a 10%, roughly 10% cut, from the 14-15% we have gotten used to over years and years, right? And all corporate data is always looked at in nominal terms. So when we look at top line growth and obviously following from that bottom line growth, that's all nominal data. We don't strip out the effect of inflation when we are making these forecasts. So when your economy is growing 5%, right, how on earth can your companies, the large companies who eventually will become mirrors of the economy, grow 15-20%? And which is why I've always found this bizarre thing about Indian analysts, that they start the year, every year, go back several years, they start the year projecting 17-20% growth. And when you disaggregate the numbers, this is all like living in la-la land. And by the time March comes around, or let's say February, March, come around, it's down to like 5% or 7%. Exactly what has happened in this year. And that's the kind of forecast you're looking at for 16-17. So large caps cannot have directions or trajectories which are very different from the nominal GDP growth of the economy, and that is running at 5% or whatever, 5.5%. You cannot expect large caps. So that was my basic case, that with the collapsing commodity markets, obviously inflation comes down, WPI at least comes down, and because of that, nominal GDP comes down, and hence that 5% is simply not enough to propel a bull market in large caps. But in my view, that 5% is adequate to propel growth in small caps or mid caps, because those kinds of companies can derive growth out of very localized markets. They can be very regional players, they can be very segmented on a certain kind of if you're looking at infrastructure, certain kinds of infrastructure. So for them to grow their revenues 40-50%, even 100%, is something that is believable and that's plausible. So hence my shift away from looking at large caps as a viable investment option to small caps, mid caps over the last 18 months. That was the central rationale underpinning that move. And if you look back, I mean, think about it. I mean, last year, 2015, they have blown out the lights, and on a relative basis, it's like I think 14-15% point relative gain for mid caps and small caps just on the index alone. And if you look at individual stocks, then you're looking at many 40, 50, 100%ers. And I do believe that incrementally in India there is still a bull market on for small and mid cap companies. So it's a completely Jekyll and Hyde market that we have. Large caps, I think, are going nowhere but down. I think mid caps and small caps are going flattish to up. That's the broad call that I have on India.
So how much absolute downside do you see in the large caps? I mean, do you think that the index can go back and retest its previous high, that the Sensex of around 21,000 and the Nifty of around 6,300? Do you think it's conceivable that we can retest that in 2016?
That's possible. I mean, I cannot rule that out. I mean, that's like a 15-18% move or thereabouts, which we have seen worse. So if you just get that, I think we should be happy. We'll take that. And obviously, a big part of that move will come because of the banks, because again, banks literally are a mirror to the economy. And when you have nominal GDP growth at 5% or 5.5%, then to expect banks to do well and to grow assets with the right quality beyond a point, I don't think they can walk on water. They have walked on condensed milk, but I don't think they can walk on water. So I think that's the area of the maximum risk in the market that exists right now, because commodities have been crushed anyway, and I don't think your consumer companies can fall because of the inherent nature of the business. So when you have a market down drift, then it's obviously the leveraged plays that get hurt the most. And what can be more leveraged than a bank?
So you wouldn't buy private sector banks even after their fall? I mean, names like ICICI and Axis, the big ones, have lost 30-35% of their market cap. You think they're good for more on the way down?
Well, if one makes a case that the markets can look at a 15-18% downside, in my view, the biggest cuts will come from the banks. So I think it's a tad too early to get bullish on the banks.
You used to like autos, but Tata Motors has had a really rough 2015, and even the gloss seems to be coming off some of the crowded trades out there like Maruti. Where do you stand on that now?
We have liked autos, I mean, you know that. I mean, in fact, the reason why we turned bullish around, I think, January, February 2009, but not bullish enough in hindsight, was because auto numbers had started improving, even though the economy wasn't, reporting good numbers. And I remember that the Maruti's numbers in October 2008 or November 2008 were like blowout numbers. And, that's when I looked at the number, I said, wait a second, I mean, there's something changing in this very gloomy picture. And that trade has, I mean, the entire pack of autos have done phenomenally well, in the last 6-7 years. But, it's inevitable, Uday, and that, crowded trade that's the place where people will take their money off the table. But within large caps, and obviously you're a mutual fund or a large FII, you can't go and buy small caps, and you can't stuff them with small caps, and I wouldn't even recommend doing that. I think you are still fine with the auto pack. I mean, I don't think they are like headed and falling off a cliff as leverage plays can, because they don't have leverage. So I still like them on a relative basis. I think they will still outperform the markets. But obviously, in a bear market, nothing really, there's no real genuine hiding place. If you go back to 2008, there's only one stock that I think in large caps that actually delivered positive returns. Only one stock, and that was Hero Honda. So that tells you that even in a terrible bear market, these kind of plays do reasonably well. So I'm still optimistic on a relative basis on autos.
What about global plays, since the world is in turmoil, things like IT or pharma?
Well, they are again, safe havens within the context of, because they are rupee and, all the usual stories are attached to them. But I do have concerns on, IT on a very long-term basis. I think they're still okay for now, but, I do believe that, the business models are now kind of, they need big-time reinventions. If you have, an Amazon, with the Amazon Web Services, cloud, I'm not sure whether our companies, at least right now, the way I see it, are positioned to be very, very transformative. And which is, I think the managements also realize that, and which is why you've had an outsider coming in for, Infosys, a more tech-oriented rather than services-oriented kind of perspective or mindset. I think all our Indian companies will need to reinvent themselves, but I don't think that's an immediate threat for like the next quarter. I mean, so I think they're all okay. They're safe havens, but like I said, don't expect big absolute upside from these kind of large cap companies. They will, I think we should be happy if the market falls 15-18% and they are down 5%. I think that's the kind of relative trade you're looking at as far as these safe havens are concerned.
Okay, we are out of time. We'll have to wrap it up there. It's been scary, but a pleasure talking to you, Shankar, as always. Thank you very much for your time today.
Thanks, Udayan. Thank you.